welcome to all of you on this webinar. Uh, it's been some time since I did a webinar, and you may be wondering what is this market volatility that we are talking about, right? So markets are at a high, mid and small caps are trending. Not only Indian markets, even global markets are also trending. Okay, so where is this volatility that we are talking about? So let me start off with a bit of a poll. Okay, because small caps have been really buzzing around and rallying, and a lot of people have told me that are asking whether they are overvalued. I thought before we give our view, please share yours. Yeah, we'll just give a few seconds for everybody to put in their poll. Yeah, so you can see here almost like 50% feel that small caps are overvalued. Okay, it's interesting that, of course, the rest is almost equally broken up between, no and not sure. Okay, so it's a bit of a mixed verdict. Okay, uh, I will not give my view right now. We'll probably go through the session, and at one point we'll also have a small cap valuation slide, and I think that's the best way and right way to decide on, or whether to agree on the point that small caps are overvalued or not. Okay, so thank you. So if we look at the global and domestic macro, I think India is reasonably well placed. A lot of positive news coming out, whether it's resilient macros, we are doing reasonably well. Whether it's healthy balance sheets of companies, if you look at also the domestic demand is strong. Okay, and there have been good reforms, some continuation of the earlier reforms, as well as focuses on, I think, the right areas, infrastructure spending, and various other reforms. So that has been a bright spot, and I think India is now being recognized globally as well. And I think it's broadly consensus that everybody is reasonably bullish on India and its growth. Right? Of course, on the global side, while few markets like the US are let's say in momentum as well. So it's not only India which has done well in this last 1 year. The US and Nasdaq again has done very well. Okay, so but in that backdrop, we're not seeing it in terms of on the financial side. If you see the global macros are sort of deteriorating, debt levels, even the US hit its ceiling and regularly hits its ceiling, debt levels that they've set for the government, okay, set for themselves. So that is something which continues to sort of deteriorate. There are a lot of policy measures which various governments have come up with. We've seen some of these contradictory measures in countries like China. Okay, so and globally also here and there have been various measures that governments have come up with. And of course, one thing that has been bothering all of us is the heightened geopolitical tensions, and what was thought to have ended very quickly now is taking long, and probably there's no end in sight even as we speak today. The Indian economy, on the other hand, has been pretty resilient. Okay, so yes, there was a blip that we saw at the COVID time. Okay, so when the GDP growth sort of came up very sharply. Okay, but subsequently, you can see the pickup has been strong. Inflation also spiked earlier in line with global markets, and that will also sort of come off. What is heartening is the GST collections have been very, very strong. Okay, and continues to be strong even past the period which is represented here. Okay, so that's been a positive. It sort of is a reflection of how the Indian economy is doing, right? So the current account deficit also has been under control, and that is a good sign that we can see out here. Uh, Interestingly, India and its position and global standing has significantly improved over the years. Okay, so there are two ways to look at it. One is to say what is India's share of world GDP, right? So you can see that from 75, you're probably 1% plus or minus, and today we sort of 3.3%. So we've gone up in share, okay, which means we've grown up much faster than the rest of the world. And so we've now 3.3 times that value, right? So similarly, and more interesting is this one on the right hand side, which talks about India's contribution to global growth, right? So it basically is saying that today a good portion of the global growth is coming from India. We're now the third largest, okay, in terms of global growth after our contribution to global growth after the China and the United States. So that is something which is interesting out there. Uh, we then move on to the opportunities, and one wanted to give a backdrop of the opportunities. We'll also talk about the risks. In fact, we'll talk more about the risks and have more charts out there. Okay, so the opportunities, one is, I think, that of the economy as a whole, right? So you'll see that as the per capita income rises, and this is what we are seeing. And if you go back and see, how, for example, the US per capita GDP grew in the past, and how new sectors come up, and they help widen and grow the economy much more deeper, right? So you will find that a lot of the consumer discretionary spending and get more deeper and wider. So as the economic progress happens, right? We ourselves, have a bit of a multi-bagger framework. So we believe that if you focus on a couple of things, companies which have good earnings growth and companies which are fairly or undervalued, okay, compared to say the leader, then you definitely have some space to achieve multi-baggers, and that is something we have a few portfolios which have done well, and I'll come back to that a little later. The Nifty valuation, the good part is this time, the growth in the index has been backed up by the growth in earnings. Basically, that means profit growth of the Nifty companies in the same proportion, right? So it is looked at how is the earnings per share of these companies, and you'll find that the earnings per share has been growing strongly. So if you look at it doubled from say almost 21 to 22 levels. There was a big jump that we saw in terms of earnings growth, and from there it has continued to be reasonably strong, right? So that is sort of a good positive in terms of our whole outlook for the economy, as well as because the Nifty is sort of a leading indicator, and what's important is that the earnings growth has been higher than the growth in the index, which is why if you see the topmost right table that you have, you will find that the P ratio, right? So has gone down. Interestingly, from pre-COVID, it was like 28, 29, right? But you would find that today it's closer to 23. Okay, so that's been so what that basically means is, the companies are are fairly valued. They're not really cheap, but definitely they are not expensive. So from a long-term perspective, I'm saying first of all, the Nifty valuations are definitely not stretched. We'll come back and discuss also about the valuation for the small caps, right? And if you see here, earnings growth is expected to continue to be strong, right? So that is a good part of it, and hopefully that will also drive markets in the medium to longer term. Okay, so And this is what I was saying. We have a mid cap and a small cap portfolio, and our point of the opportunity is there in the mid and small caps. The opportunity is there for you to pick good quality stocks and see, if they can be multi-baggers. Um, and of course, this is just a mid and small cap. It's not even a pure small cap portfolio. And something like this, if you look at even a 3-year compounded almost like 39%. Okay, so where you're able to sort of identify stocks, identify the multi-baggers, and sort of invest into them, you'll probably see sort of better than the index as well. Okay, so even if this has the by SEBI regulation, we need to sort of compare it with BSE 500. But even if you looked at the mid cap index, there would have been a good alpha versus the mid cap index as well. Okay, and this is what one is trying to say. The opportunity still is in doing the hard work and identifying companies like what we've called our multi-bagger framework, right? Where we see a combination of earnings growth. So if you have a company which can double, say, in 3 years, and if that is the time frame that you're looking at, 3 to 4 years, if you can have earnings double in that period, then probably the stock price is also going to double. But if you also are able to identify companies where there is going to be a re-rating of the multiple, okay, where it gets discovered by the market, like what we are seeing from, let's say, IRCTC when we bought it initially was 35, but when we sold it at 105, right? So just from P re-rating, okay, you would see a 3x and there was earnings growth of 2x. So typically, you will find a company like this would have, had gone up for us almost like 6 times. Okay, so that is broadly sort of the thing that we're looking at, and that is something that when we saw some of them coming up, we said, how do we make it repeatable? How do we make it into a framework? And that is something that we looked at. Of course, some of these are the ones we hold. The earlier slide was ones we shared it because most of them we don't hold. Okay, and just to give a disclosure, that was not a stock recommendation. Okay, we have exited many of those stocks. Okay, so this is neither, but it's only an illustration to be able to explain a concept to you, right? So if you see 24 and beyond, what is it? Some of the things that we're looking at, we are going back to sort of the core sectors, manufacturing. We identify construction, so which was not to directly go to real estate for various reasons, and there's a lot of cash involved and a lot of impact of government intervention at a company level and stuff. So we felt that it's better to focus on, say, construction materials and what inputs that go into construction. So those are things that some of the areas that we look at. Again, we are saying how do we look at companies where we can expect, say, 2 to 2.5 times earnings growth in a 3 to 5 year period. At the same time, if we also end up seeing them at a discount, what is the expected return is assuming there's a re-rating. I mean, the setup, like I said, 5x, maybe 4x, it may be 6x. Okay, but the whole point is simply if you have earnings improve, typically the stock price moves in a similar manner. And secondly, if you are able to find some of the stocks which you find expansion in P, you will find an even higher kicker than that over a period of time, right? So what are the risks? And I think this is important, and because right now everything is hunky dory, I want to spend a little more time on the risk side. Okay, and so what are the risks that we are seeing, and why is it we are talking of volatility when markets are at high? So we believe that when you find either a stock or a market at a high, there will be increased volatility, which means it's not unusual also for us to suddenly see even a 500, sometimes even 1,000 point increase or fall. We've been seeing that in recent times. So those are things that will come in. So what are the macro risks that we have? We have this right from geopolitical. Okay, there are a lot of ones which also are coming on the horizon, right? So there's the whole Taiwan stuff. There's the Iran. Okay, so China is also looking to build its bases even in the Indian subcontinent. right? So there is a lot of things out there. So definitely, I think geopolitical is something which is one of the larger risks that we are looking at this point of time. The second is we are seeing a bit of a slowdown risk. Okay, and what is the rationale we are saying? And specifically, we've highlighted the US, right? At the same time, US markets have done well. The US economy, so to say, has been reasonably good. Okay, companies also have been decent. Okay, what is it that we are bothered about, and why do we feel the trigger? US is very sensitive to interest rates. Okay, one of the reasons why US saw a very large market rise in the last decade, right, was falling interest rates, but they kept interest rates low, right? And however, now interest rates are definitely higher than what they were. Yes, there were extreme levels, and US for a period saw 10% inflation, right? So which was unimaginable. Okay, but that has come off, but it's definitely not going to go back to levels that it was earlier. And interest rates also are unlikely to go back to levels that it was earlier. Okay, so over a period of time, what this means is for consumers who are borrowing, okay, their cost of funds is going up, and they're just paying extra money as interest on their loans, right? And keep in mind that US is a reasonably leveraged country. So that is something that we are sort of concerned about, and we believe it may have longer term impacts, and that is typically a very long and painful process, because how it ends is not necessarily very nice typically, because you also end up seeing NPAs, when you have high interest rates, and that has potential to impact, say, banks and the economy as a whole. So that is something that we are talking about and saying we should sort of keep this in mind. And under that, from whatever our belief on interest rate is banking stocks is what we are saying is something to watch out for, right? So now there's been sustained fiscal tightening, of course, because inflation was not coming down. Of course, in recent times it has come down, and there have been talks of loosening, but however, markets were expecting it earlier. We think that will take some time for you see, central banks start cutting interest rates. Now, if central banks cut interest rates, is that a good thing? It's not necessarily good, because typically they cut it when the economy is not doing too well, right? So that is something which first has its impact in terms of negative, and subsequently, you may see a lower interest rates benefit after a series of cuts. Because that is something that we're talking about. Domestic macro, yes, there was that huge spike that we saw post COVID, and you saw that in earnings growth, right? There was a huge spike, and that now the base has moved up. So you will find in relative terms, just because of a higher base, also you will find the relative growth will sort of come down. Okay, however, of course, in the really long term, we think that India will still do reasonably well. But yes, there could be periods when suddenly the investor is used to, say, profits growing by a fast pace, and suddenly the base has changed, right? And on a higher base, it's not possible to grow as fast, and there is an impact, and people suddenly reset. So that's something to there could be a market impact in the short term, if some of that pans out. So that is something to sort of watch out for. FIs have been erratic. They've been swinging between inflows and outflows in the last few months. Okay, of course, yeah, the good part of inflows has been coming in. Okay, and so there are some bit of concerns also on job creation and infra. Again, this time there was in the budget there were some concerns that infra spending is not as rapid as it was, right? So that is so those concerns are there also, whether it will impact. Definitely, there's a question of elections around the corner. What is of course, if there's a negative impact, then that's going to be have a reasonably short-term impact. Okay, but I think broadly our view also is that we don't expect a change in government for this period. Okay, so infrastructure spending, uh, again getting postponed is something that is there. Now, I did speak about Nasdaq and also the broader US market. Okay, this is what I was saying, that Nasdaq is at an all-time high. Okay, what is concerning, and this is a risk that we have, is it's very concentrated in the top 5, 7 stocks. Okay, so and like somebody was just telling me yesterday, yeah, it's the whole Nvidia is a single company is larger than the market cap of all energy stocks in the US, right? No, that data needs to be verified, but I'm just saying that it's some of these stocks have really run up very, very sharply. Okay, so that is a bit of a concern. And when you have let's say an index growing which is skewed, it's an even higher risk. Okay, so that's something that to watch out for. Because and what are we seeing there? Typically uh, Nasdaq ideally our view should have come off, after a very great decade. Okay, but it had a fresh trigger from AI. Okay. Now, the typical thing that happens is when the first sight of something new happens, there's a lot of euphoria, enthusiasm, and stuff, right? But then suddenly people step back and say, okay, this is all great, but is this going to happen overnight? Okay. And so we think some of that, it will definitely also lead to a bit of a cool off of some of these stocks. And the issue is when they run up very fast, the falls also can be larger. Right? So that's something to be concerned about. Dow Jones also has gone to its highs. Of course, you will see that Dow Jones rise was also not as quick. Okay? If you look at it in percentage terms, it may not be clearly visible because the charts are of different periods of time. Okay, but the Nasdaq had grown much faster than Dow Jones. So to that extent, it was not as in momentum and overvalued as, let's say, the Nasdaq, but that also has sort of picked up the recent past and also gone to highs. Of course, you will see that, and this is what I'm also trying to suggest, that when the volatility happened between this say 21, 22, and probably into 23, right? You will find that the dip of Nasdaq was bigger, right? So something goes up sharper, also you will find that the falls are also sharper. Now coming back home, and this is where I said we'll come back and see, in line with our poll, is this small cap index overvalued, right? So two things. One is if I look at the left chart, it's the move has been very, very steep. So that is something, there's no question about it. There has been a steep, uptick in the index. But on the other hand, if you see the right side, interestingly, okay, the small cap index has actually grown slower than earnings. Okay, so like what I was saying, the earnings growth has been faster. And interestingly, even in an index which has grown very fast, okay, the earnings of small caps has really grown fast. So it could have certain room left. Okay. But what are we saying? Right. So we are saying that it's not overvalued, but because it has moved up very sharply, you could see corrections which can also be relatively sharper than what we have experienced in the recent past. Okay, so it's a time to manage risk, is what we are trying to say. Okay, so even in our portfolios, for example, we have looked at taken steps, say a flexi cap, which allows us to be a little more flexible. We've even taken a cash call. Of course, not an extreme cash call. We've taken it to a level because the very long term is we are very bullish, so we don't want to go completely against it because we have to keep in mind that markets sometimes surprise you, right? So what if it just goes up, continue to go up from here? So from that standpoint, we also do what we call as weighting. Okay, WEIGHT, right? So we whenever we take actions, sometimes we do it in a higher percentage, sometimes we do it on a lower weightage. Okay, so right now we are booking profits with a lower weightage. Okay, so that is the thing there. So we've also taken a lower cash call than we've taken, say, in 2019, interestingly, just before COVID, right? So when we found that valuations were excessive, and that time it was, PE was 28, 29, like I mentioned before COVID, right? So that is something that, just to explain that while we are saying manage risk, we are not bearish, and at the same time, we probably saying more of be ready for volatility, manage risk a little bit. And if you have liquidity, take advantage of any correction. So that's the broad message that we had. Some sectors also in India have the PSUs, right? Uh, Public sector enterprises. Okay, so basically have been really trending. Okay, so if we thought the mid cap was moving, okay, some of these, you will see that this chart itself, shows obscene returns. And so from almost like, I think this index of say 2000, what I can see, some 8,000 odd. So right, so that's something which uh, is what we keep in mind and look at. Okay, what is the good part? Okay, the good part is, if you see the black one that I was talking about was the Nifty index, right? So which has gone up, it's multiple times, right, as the index itself, and that too from within a 3 year period or so, right? So and even if you see just from 23 onwards, the spike is really vertical, right? Just crazy vertical. So that's the type of move that has sort of happened in the short term. Now, what's the good news that I'm saying is that the orange line that you see, right, is actually the price earnings ratio. Okay, so actually it's not too bad. Okay, so the P multiple is still not bad. It's probably, from what I can see, closer to 10 or so. Okay, so that is something which is not too bad. You will find that in 2010 or so, it was almost like 29, right? So we think that there could be headroom. We are just saying for sectors which are gone into crazy momentum like this, we should be careful and watch out for potential falls or even potential long-term turnarounds. Because what may just happen in markets, it may move off to some other sector, right? But since valuations are low, we still think that there could be some room left. So probably a sector to relook at, if you find that they come off a little bit. Okay, and this is the second reason why PSUs also are running up sharply. You will find is because government holds and the promoter is the government mainly, right? So you'll find the free float is low. Okay, and some of these have really run up sharply also because the free float being low, which means there are like many lesser shares. So when people start running after some of the PSU stocks, there's lesser shares for then the let's say demand that comes in suddenly. So that's also something which sort of keeps in mind. And you'll see that just a 6 month return, okay, is mind-boggling for some of these. Okay. So in fact, we also had one, because that has a slightly higher free float and stuff, okay, which was right at the top, okay, and a multi-bagger just in less than a year, okay. So those are things which uh, you need to keep in mind. And if you are investing today, a lot of things buzzing around, names buzzing around, people giving tips. Okay, I'm just saying be a little cautious. Yeah. The other aspect we are saying that when we are a little concerned about Nasdaq in the US, and I think a lot of the ESOPs also on technology stocks, and we saw that when in the COVID fall when Nasdaq fell, you saw a similar a reflection of that in Indian tech stocks. So to that extent, we just wanted to highlight, if you have ESOPs, this is a good time to look at them. In fact, we have, I think, a good part of assets that have come to us have been from ESOPs, where we actually track the stocks, we look at triggers, and we share them with clients. Okay, and we help diversify. Now, what basically happens through that, because you're selling when it's spiked up, okay, then you have an opportunity to reinvest. At times, it happens that that sector continues to do well. If it continues to do well, as long as say the index, if you diversify it, from a particular stock, say it's a technology stock, and you diversify, right? Then if the overall index grows up, continues to go up in line with your tech stock growth, then you'll probably not have lost out money. Yeah, you lose out money if you've invested, the tech stock say continues to go up swiftly, and the other sectors don't go as fast, or you put it in some other debt type of option, then you may lose out. Okay. But our view is that if I look at even tech stocks versus, the broader index, we believe the other sectors are likely to do better. So you may just get one on top of the other. You may have exited at a better price and you've reinvested elsewhere, and that gives you a further kicker in terms of return. Okay, so that's something that it's good to do, and in the long term, it's reasonably clear. And because there were times that in the past, right, where technology really ran up for a long period of time, right, but eventually when that got over, okay, you will find that they come off, and you will find some other sector takes over, and the broader index is many times difficult to beat in the longer term. And why is that? Because actually the index is ruthless, right? So it's market cap weighted, they say. So which means if whichever the companies do well, it comes into the index. If companies don't do well, they get out of the index, or the weightage goes down. So inherently, the index is not necessarily just static, right? It is dynamic in some form, because it has a mechanism to choose better performing stocks and take out non-performing stocks, right? So that is something that you sort of keep in mind. Yes, from our side, if you are investing in stocks directly, you have to keep this in mind. This is something that we also, when we manage our fund, it's all bread and butter for us in terms of managing risk. And our view has always been that, how do we deliver a better risk adjusted return, which is why you would have found that, say, in COVID, the fall would have been lesser. Even at points like this, when we are saying de-risk, okay, we're doing it ahead of when the actual fall happens. So, so that is something where we look at. So when you're looking at your portfolio, you have to go company level. You have to look at that company, what are the business risks, what are the valuation risks, what are the corporate governance stuff, etc. So all of these on a continuing basis, so for example, all the stocks that we have, every single quarterly result, the calls are looked into, the results are studied, okay, any other news that comes in between. So there is a lot of, because we have dedicated, fund management team who have no responsibility other than, managing the portfolios. So that is something that, is required. And if you do it on your own, you have to give it that importance to maybe look at don't look at too many stocks, look at a smaller number, okay, which you can track and accordingly invest. Okay. So broadly, our view is it's about balancing risk and return, right? So there are the opportunities we spoke of, there are the risks that we spoke of. Okay, so what is it that we should do? Okay, the first thing I want to say, and which I said it a little earlier, is in the long term we are very bullish about India, and we are very bullish about equity markets, okay, Indian markets, and this is a chart that if you just look at from 99 onwards, you will not imagine, right? The fall in 2008 was all 60% or, so, but today it just looks like a blip, right? So as you go forward, if you look at long term, if you are disciplined in what you're investing, okay, automatically this happens. And like I said, the index itself is an improving index, right? So and whichever stocks do well, it sort of brings it in. Whichever stocks do not do well, it takes it out. So automatically, if you will find that wherever there's volatility, if you are disciplined. Now, if you are passive, you may just be holding that stock. Okay, and typically we've seen retail investors who are not able to track their stocks end up, with far lower return, than even the index, because, like I said, index is doing better, right? So it is always ruthless in kicking out stocks which are not doing well and bringing in ones which are doing well, right? So long term, very bullish, okay, which is why I'm saying we don't want to be ultra cautious, okay? We don't want to take very large cash calls. Even when we did profit booking, we didn't do it very large because our experience has been that you may get the timing right of exit, okay, but you have to get both exit as well as re-entry correct, right? So if you are and at the time that is the best time to re-enter, and let's go back to COVID, for example, right? You would not have felt like investing at the best point because everything would have, all the news would have been negative, right? So that's the point to keep in mind is sometimes you may get the exit right, but in the volatility, you may feel uncomfortable to reinvest, and suddenly markets go back and into highs, and you may just miss out. Right? So what we think are some of the things that you should do to, balance your risk and return. We have a structured investment process. So right from having training all the stocks, looking at the scorecard that we have, and going deeper, almost like 26 parameters. We do a ranking across those 26 parameters. Then there's a second step in it where we go into each company in detail, looking at its strategy and what all it does, what are its moats, as we call, what is the competitive advantage that it had, etc. Right? Its pricing power, and those sort of are things that we look at. Valuations is something else we look at as part of this. Okay, then we have a whole process in terms of risk radar, and the last is in terms of pendulum, which is looking at valuation. So broadly, this is the investing process that at Right Horizons we have followed. And so we are suggesting that if you have an interest in stocks yourself, then you can also go back and see what is the process that you can follow, but have a disciplined process of investing. Okay. So, and the second aspect is you have to focus on quality. Now, this is a time for quality. Okay. There are periods when quality is not respected, and that may have been the last 3 months, for example, right? So you will find that the index will suddenly go up 9% in months. Okay, and many good funds will not go up as much. Why? Because in some of these periods, the jump runs up. Okay, so that's something that you keep in mind. But in the longer term, you'll find that the jump will go up fast and they'll fall faster. Okay, so that's one important point for you to consider. So look at companies and look at companies with stronger balance sheets, market share. See the promoters. If they are high pledging, then do not invest in them. So you have to look at and study the companies there. In terms of and typically people come back and ask me, okay, which sectors are you bullish on? Of course, we don't talk about stocks because just from a compliance standpoint, when we hold stocks, it adds a lot of complexity there because we have to ensure that we don't give an opposite recommendation or, so from that standpoint, we don't like to talk about stocks, but, what are the sectors that we've been focusing on? Manufacturing, financials has taken a hit right now, and that's why we are looking at it a little actively from a contrarian call, not yet completely bullish on it, but of course, a few areas we have been. Building materials definitely something that we have been looking at. So those are things that have done reasonably well, of course, other than financials. Capital goods, consumer, discretionary spending items, and also consumer services are all the sectors that we have been looking at. Yes, you'll find that you may ask me why PSU is not here. Okay, like I said, at this point of time, we said we'll wait a little bit before we re-enter. In fact, we did exit a week or a little more back, from a couple of our PSU holdings that we had. So, in summary, before we take on questions, one wanted to summarize and say yes. The long term, I've mentioned that and reinforce that we think India will do well and it will be the country of the decade. Okay. However, like I said, markets have run up very sharply, especially small caps. Again, there are certain sectors which have done well. Okay. You found that, and interestingly, we took a contrarian call in March 23, right? And we launched a small cap fund called Super Value Aggressive. in a very short period of time, it went up very high. I've not kept, I mean, the numbers are, I would even say, obscene. Okay, so like in 4 months, it hit 45%. Even now, it's way above that. Okay, but and we stopped taking fresh infusion, due to the steep rise. Okay, if there's a correction, then we may open up something like that, and those may be opportunities again. But we would like, it's important to get the timing right in small caps. So apart from the small caps and PSUs, you'll find that when global markets have reached high, and we are a little uncomfortable, especially with the US. Okay, whenever you see these spikes, you have to watch out for corrections. Okay, and that is a very very common thing where you have a counter move that normally is there. So at this time, it's a time to balance risk and return, right? And so, what is the way to do it? I discussed: be disciplined, manage the risk. If you're an investor, look at the asset allocation. Don't go over in equity. Okay, if you have excessive return, you can book profits. Okay, but do book partial, because the longer term, is still very very positive in our view. So don't. I mean, so you have to balance it. And like I said, we are taking a lower weightage of correction than some of the past. And phased investments into markets, I think at this time are also a good way to look at it and not miss out, because the bigger picture is great. Okay, it's impossible to exactly time the point of entry, and markets always tend to surprise you. If you have ESOPs, I think it's important to de-risk it, because if it's a single company, it always is paper money. Okay, but when it's diversified, you've seen just the chart of the index, right? It always goes up in the long term if the economy is even going up. You find it true even of developed markets. That the stocks keep going up because the efficient companies are the ones get encouraged, and they are the ones that lead things forward, right? And however, I'm saying tighten your seatbelts. Okay, uh, if you have the ability and the liquidity on the market volatility, I think you should take advantage and invest at such times, and it will only help you enhance your returns. I think that's all from my side. So I I will open the floor for questions. Sanjay, if you can.
Thank you so much, sir. Thank you for sharing valuable insights. We are already having few questions in the Q&A section, which we'll be reading it out one by one. So the first question is from Mr. Madhusudan. The question is, with market overhyped and euphoria all around built up, is there no scant respect for asset allocation model at all? Does it each and everyone should run after equity only and chase returns alone only?
So Madhu, unfortunately, that's exactly what happens. Okay, and as investors also, you know, as people, we are used to looking at, okay, past track record, okay, and then say, no, let's invest. Okay, unfortunately, with markets, past track record need not mean the future. Okay, and it could even be a great fund manager. Okay, investing, for example, invested in PSU stocks, and that moves turns around, and some of the sector moves, right? So to that extent, you may just find for just choosing. Of course, I've chosen a very extreme example, right? Then it may not be as extreme. I would have chosen 7, 8 sectors which I'm bullish on. It doesn't unlock this year. It may unlock after 2 years, right? So that is the issue. But money chases returns, unfortunately. Okay, because when people tell us, okay, this thing has gone up 50%, in fact, and this is why one also wants to highlight it, right? I had at least 2 clients, and couple of them, both senior citizens, and should not have been taking a risk. And somebody comes and tells them, oh, you know what, this thing went up 100%. Okay, right? And one of them was a PSU sectors, for example, right? And my point to that person was, yes, but if you if this already gone up, say 50%, 60%, do you think you should still invest now, and do you think it will still go up by 50 or 60 from here, right? So that's unfortunate, but I think as an investor, asset allocation should be your holy grail, right? So it should be your base for what you do. Of course, at right horizons, we like to do a dynamic asset allocation. Okay. So which means that when markets are lower, we think there's lower risk. I don't mind putting little higher than my average asset allocation that I've chosen for myself. Okay. So similarly, when markets at a high, I would like to be lower. Okay. But I'm still saying you can be at your asset allocation at this point of time because long term we still believe is positive.
Thank you, sir. The next question is, what's your view on the semiconductor manufacturing impetus in India? Do you think these companies would be multi-baggers in next 3 years?
See, there's a huge difference between the stock making returns and being a sunrise sector. Okay. So I'll give an example of solar. That everybody, no brainer, solar is going to be used much more, and governments are going to suggest it. It's going to become an important thing. Okay, but nobody has made great money on solar in India, right? In fact, there are companies which have gone bust. Okay, because they were in solar, and why? Because the prices of solar panels were coming down. So I'm saying the similar thing. I think semiconductor. I think for Indian companies, we are not yet right on top of that curve, right? So there will be learnings, there will be periods of time, and semiconductor actually has already become hot. So wherever there have been crazy ramp ups in capacities all over, so it's not the opportunity that was there before is not necessarily there now, right? But in the long term, yes, it's going to be a good one, but you need to study the companies and the stocks.
Thank you, sir. Mr. Anand has asked about how to start invest. Like he said that I'm an NRI. What's the amount I need to invest with you to start, and how do I do this?
Yeah, so okay, so how much you should invest with me? I'll say your whole portfolio. Yeah, jokes apart. See, I think it's all about there are both high risk options, there are also low risk options. Okay. So in the end, it's about oneself. Uh, you should go back to looking at what are your goals, what are your needs. Okay, what is it required to be able to achieve that? Right? And your investing journey should be in sync with that. Okay. So I think giving an offhand answer without knowing the circumstances is doesn't make sense, right? So it may make sense for us to, somebody to look at it, discuss data, and see what is right for you. For somebody, it even may be that 1 lakh rupees may be as important for them in that journey. For somebody else, it may be 100 crore, right? So it's just so I'm just saying it's too personal. It depends on a whole lot of other factors. But yes, if you're asking me in equities, again, I'm saying the same thing. To the extent you want to get into equity allocation that you've chosen for yourself in your asset allocation, okay, you can do it in a phased manner. If the amounts are larger, then the phasing can be longer. If the amounts are smaller and you yourself think there will be more money to come in the future, okay, and liquidity to come in the future, then you can go a little faster, right? So I think that's the whole point. But yes, if I'm putting anything lump sum right now, my suggestion is just phase it out and keep it.
Thank you, sir. So Mr. Nikhil has asked your view regarding the diversification. He has mentioned that majority of my portfolio includes PSU stocks. I own all the PSU stocks in some or other proportion, dominant portion being of railway stocks. I'm at very higher risk, and where should I diversify?
No, so that's exactly the problem. Because see, what happens is for the lay investor, right? You'll find that uh, you know uh, a lot of the news and flow comes on that side. Okay. And unfortunately, there's no trigger to you that will not come to you. Stop. Okay. Because in momentum, people keep on going because sometimes when you look at technicals and most analysts uh, have a certain breakout style, right? So there are very few of them who will also look at, say, Elliott wave and based on that say, okay, this is a turning point that I think will come, right? So So it's not surprising. Okay, so this is my thing for you today. It's important to diversify. Okay, what does it? Okay, if I were you, I'll pull some back into cash, and whatever I get into cash over the next 6 to 8 weeks, I will even just face it in. Okay. I did discuss with some of the manufacturing. You can use index funds. You can use, portfolio managers. You can use. So you choose whatever is comfortable for you. If you want to do it yourself, definitely, look for more conservative avenues. Look where valuations are lower. Use screeners to sort of put in certain parameter and then come back and say, okay, which is a short list of stocks that you can use. Yeah, but I'm just saying I will be cautious on PSUs at this point of time. I'm not saying go to zero, but but keep in mind that could be volatility, and it's possible that after a correction you may come back and add a little back into PSU stocks.
Thank you so much, sir. So there is one question from Mr. Prasan. Ideally, what should be the number of scripts one should be holding to maneuverable and control?
Yeah, typically I think if you are okay with concentrated portfolio and really good at tracking stocks, it's 15. Okay, but typically you can look at something like 20, 25, I think is a good diversification to have. And within that, it's important also what you do. Like you cannot have one stock, because sometimes it happens that say our ESOPs maybe just 80%. Right? So that of course, maybe for various reasons, keep that aside and see how to diversify. But within your portfolio, you're managing, sorry, then you look at the restrictions like, okay, I will not go above 15% in a single stock. You try and see if you can capture sector weightages and stuff like that. So that, if by chance you have invested into something, and I'm just saying for this example of PSU, right? If the turning point comes. So at this point, am I sure? I don't know, right? But we are thinking that based on data, there will at least be a correction. And some of it is already happening today if you are seeing, right? In the last few days, they've been a little bit more volatile. So to diversify and, take care of your risk. Yeah.
Thank you, sir. So Mr. Neeraj has asked, you said US is a levered economy with its banking assets at risk. With de-dollarization coming in big way, would dollar would be in position to sustain its global dominance?
Yeah. So it is a concern, right? So and typically you'll find that there are mega trends, right? So there's some trends which are say yearly, there's some decades, there's some much longer, right? So the mega trend was that US came up in dominance, China came up in dominance and stuff like that. We are hoping that India will be part of a mega trend, right? And we come to a new level of as a percentage of the global economy and stuff, right? So that is something which is there. So if and we think that both from how the US economy performs in the medium term, as well as from countries will be looking to de-risk as well, and say there have been after some bit of this Russian crisis that they had in terms of the war. Okay, there has been a push for currencies beyond the dollar, right? So that will, I think, continue in a medium to long term. And at the same time, it's difficult for so much dominance to go away in a short period of time. I'm saying short period can even be 25, 30, 40 years, right? When you look at decades. Okay, so I'm just saying it's not going to happen overnight, and US dollar is going to remain there for a period of time, but slowly the dominance may erode, and at some point there could be an inflection point, and suddenly it comes down faster.
Thank you, sir. So I think we'll take last two questions. So the question is, what's your view on the AI market boom on Nasdaq? Do you see AI as large market creation event similar to the internet? What about the semiconductor companies' role in AI space? Would this really continue?
Yeah, so see, the thing with emerging sectors is like what I always said, right, is maybe today the US has some things like in uh, AI, etc., which are there, okay, but emerging sectors, and we said semiconductor is sort of one of them. AI is another. Okay, the emerging sectors are really difficult to predict. Okay, so you have to be able to study those companies very deeply, and your ability to understand technology trends and whether this company is able to fit into that technology trend, right? It becomes something which is important. So, so, uh, so I'm just saying emerging themes are ones which can do well, but it requires that much more study and getting into a few levels deeper before you make such investments.
Thank you so much, sir. The last question is, there is general talk that once net worth goes up, people move towards higher TKT products like PMS, AIF, etc. How good is this, or is it better to stay in mutual funds?
We always like to have a diversification for our clients. We typically, after they go our side, we'll have both mutual funds and PMSs. If they really become large after some time, we may also do AIFs in a smaller way. Okay, so it's all about diversifying styles. Yes, PMSs typically are higher risk, higher return. Okay, so that is something to sort of keep in mind. PMSs have a lot more flexibility than mutual funds have because the mutual fund is meant for, say, retail investors as well. So the regulators have been very conservative in terms of, for example, what they allow, including saying specifying these 100 stocks only, comprise the large cap index, right? So to that extent, you have less flexibility there, and you may find it may be a little safer, but it may also be lower return. So I always think it's good to have a diversification between both of them.